Ever feel like navigating a new country's financial landscape is like trying to solve a Rubik's Cube blindfolded? Today, we're diving deep into a topic that can feel exactly like that. The intricate yet incredibly powerful world of tax benefits for new immigrants, or Olim in Israel. Making Aliyah is a monumental life step. And understanding these financial provisions isn't just about compliance, it's about building a robust foundation that could genuinely save you, well, potentially, hundreds of thousands of shekels.
And that's precisely where we want to take you today. Our goal isn't just for you to know these benefits exist, but to really understand how to strategically leverage them.
Right.
It's about unlocking that potential for financial growth from day one and, crucially, sidestepping those common, often very costly mistakes that,
Yeah.
frankly, many new Olims unknowingly make.
Absolutely. Think of this deep dive as your shortcut to being well-informed. Our mission today is to unpack the core tax benefits for Olim, maybe demystify the Israeli tax system a bit, and equip you with the practical knowledge to make some highly informed decisions. We've drawn from a collection of essential guides on Olim tax benefits, financial planning, all tailored to help you navigate this complex journey.
And what's really critical to grasp up front is the timing. Many of the most impactful decisions around these benefits, they need to be made early, sometimes even before you physically arrive in Israel.
Before you even land.
Yes. Missing a deadline or misunderstanding a nuance isn't just an inconvenience. It can have significant, long-lasting financial repercussions. So proactive planning isn't just an advantage. It's a necessity.
Okay, let's unlock the biggest piece of this financial puzzle then, the 10-year exemption from Israeli income tax on foreign-sourced income. It sounds incredibly generous on the surface, but what's the truly powerful insight here? What exactly does it cover, and why is it so transformative?
The real beauty of this benefit lies in its sheer breadth and duration. For a full decade, 10 years from your date of Aliyah, you are exempt from Israeli income tax on virtually all income generated or accrued outside of Israel.
Okay.
Think of it like a powerful financial shield. We're talking about both passive income, things like interest earned on foreign bank accounts, dividends from international stocks, or capital gains from selling foreign real estate or bonds.
So investments mainly.
Investments, yes, but also active income. That includes salaries from a non-Israeli employer or profits from a foreign business, even if you're physically performing that work from within Israel. It essentially gives you 10 years to reorganize your global financial life without immediate Israeli tax implications on those foreign earnings.
That sounds like an unparalleled advantage, but I've definitely heard a persistent myth, maybe a dangerous one, that says everything is tax exempt for 10 years after Aliyah. For someone hearing 10 years tax-free, what's the immediate, red flag they should be looking for?
You've hit on a crucial point there. That myth is a dangerous misconception, and it leads many people astray. The exemption only applies to income generated or accrued outside of Israel. That's the key.
Right. Origin matters.
Exactly. Any income earned within Israel, like a salary from an Israeli employer or profits from a business operating solely within Israel, that's subject to full Israeli tax from day one. And here's another vital distinction. This exemption is for Israeli tax only. You might very well still have tax obligations in your country of origin.
Ah, okay.
Which is why properly severing your tax residency there before Aliyah is absolutely vital to avoid potential double taxation.
So it really comes down to the origin of the income. That's a crucial distinction many might miss. Let's bring this to life with a real-world scenario from our sources. We heard about Ronan, the investor and entrepreneur from Singapore, who used some truly ingenious strategic planning during what's called his adaptation year. How did he manage that?
Yeah, Ronan's case is, it's a masterclass in pre-Aliyah planning. He arrived in Israel with a significant foreign investment portfolio. Now, he knew that once he became an Israeli tax resident, any future capital gains on those investments would be subject to Israeli tax.
Makes sense.
So he strategically utilized his adaptation year, we'll definitely unpack that next, to essentially lock in all the accumulated profits he'd made up to that point, completely free of Israeli tax. He did this through something called a step-up operation. Basically, he sold his assets and then immediately repurchased them.
Sold and bought back.
Right. This move reset their cost basis, that's the original value used to calculate future profits to their current market value. And he did this before he was considered a full Israeli tax resident. This saved him a substantial amount by ensuring that only new profits generated after his full residency kicked in would potentially be subject to Israeli tax later on.
Wow. So he essentially got a financial reset button for his foreign assets just by using that year strategically. That's a phenomenal strategy. Which brings us neatly to this adaptation year, or Shnat Histoglit. It sounds like a powerful tool, but maybe a bit complex. What exactly is it?
The adaptation year, Shnat Histoglit, yeah, it's a unique and often misunderstood provision. It allows new immigrants, and also, importantly, veteran returning residents, those who've lived abroad for 10 years or more, to choose not to be considered Israeli tax residents for their first year after arriving.
Okay, so it's an option.
It's an option, exactly. Think of it as a strategic test drive period for tax purposes. It gives you a crucial 12 months to acclimate, sort out complex financial affairs abroad, maybe make those step-up moves like Ronan did, all without immediately triggering full Israeli tax residency for your global income. But, and this is a major caveat, the request for an adaptation year must be submitted within 90 days of your arrival in Israel. 90 days.
Wow, that's quick.
It's incredibly quick. Miss that window, and you lose eligibility entirely. I've seen Olim, amidst the chaos of moving, miss that deadline, and the financial repercussions can be, well, heartbreaking. And the decision, once you make it, is irreversible.
That 90-day window sounds incredibly tight, especially when you're dealing with the whirlwind of making Aliyah. So during this adaptation year, you essentially remain a foreign resident for tax purposes. What are the key pros and cons here, especially since it's an irreversible decision?
It's definitely a nuanced decision. It requires careful thought. While it's incredibly beneficial for that kind of proactive tax planning we talked about, like Ronan's step up,
Right.
it can sometimes actually be disadvantageous if it doesn't align with your specific circumstances. For instance, opting for an adaptation year means you might forfeit certain income tax credit points, we'll touch on those later, that you'd otherwise get on any income you earn in Israel during that first year.
Okay, so a trade-off.
A potential trade-off, yes. Also, and this is a significant financial consideration, it could require you to purchase expensive private health insurance for that year. And here's a really critical distinction to highlight. The adaptation year is for tax purposes only. The process for national insurance, Bituak Lumi, and getting access to public health services, that's entirely separate.
Completely different track.
Completely different. New immigrants are actually exempt from national insurance payments for 6 months, sometimes extendable to 12 if they have little or no income. But there might still be a waiting period for health services. You can waive that waiting period, but it involves paying a specific fee for 2025. It's around 15,000 shekels, so roughly $4,500 USD. That's a significant sum to factor into your early planning if you need immediate health access.
That clarifies a lot. So it's definitely not a blanket good idea. It's more like a calculated risk, a strategic tool that really depends on your personal financial picture. Okay, moving beyond income. Real estate is often a huge consideration for new immigrants. What specific benefits are there for Olim in looking to buy property in Israel?
This is another big one. There's a really significant benefit related to purchase tax, or Master Shisha. This is a one-time opportunity specifically for new immigrants when they purchase either a residential or a business property.
One time only.
One time only, yes. It's designed to significantly reduce the tax burden when you buy property, making it more accessible. But crucially, this benefit must be used within 7 years of your Aliyah date. 7 years.
Okay, 7 years. Now, I understand there were some pretty significant changes to these regulations back in 2024. This sounds like a classic example of where the timing of your Aliyah could mean vastly different opportunities. Can you break down the old versus new rules for us?
Yes. The 2024 changes were quite impactful, and you're right, your Aliyah date is the absolute key here. So if you made Aliyah before August 15th, 2024,
Okay.
you actually get a choice. You can opt for either the old regulation, known as Regulation 12, or the new regulation, Regulation 12A. Under the old regulation, you'd pay a reduced tax, 0.5% on the property value up to approximately $2 million NIS, and then 5% on the value above that threshold.
And the key difference?
The critical strategic implication of that old rule is that it allowed the benefit to be used for investment properties or business properties, not just your main home.
Okay. So flexibility there for pre-August 2024 arrivals and for those who came after that mid-August 2024 date.
Right. For Olim, who made Aliyah after August 15th, 2024, they are subject only to the new regulation, which is Regulation 12A. This new framework offers a full exemption on property value up to about $2 million NIS.
Zero tax up to $2 million.
Zero tax, yes. Then 0.5% on the value between $2 and $6 million NIS, and 8% on the value between $6 and $20 million NIS. There's no benefit above $20 million NIS under this new rule. But the fundamental difference is this. This new benefit is strictly for a single residential property only. It cannot be used for investment properties.
Okay, that's a huge distinction.
Right.
Residential only for the newer Olim.
Exactly. So for those arriving after August 2024, if you're planning to purchase an investment property, you'll be facing the standard purchase tax rates without this specific OLA benefit applying to it.
That's a profound difference. It means for some, there was a window for significant savings on investment properties that's now closed for new arrivals. Planning is absolutely critical here to maximize savings, which, could easily be tens or even hundreds of thousands of shekels depending on the property value. That truly is a game changer. All right, so beyond these, let's say, cornerstone benefits for income and property, there are other crucial financial advantages that maybe seem smaller but can really impact your daily life and long-term stability as a new immigrant. What else should our listener be aware of?
Yeah, there are a couple of often overlooked opportunities that are definitely worth knowing. First, there's an exemption on interest from foreign currency deposits in Israeli banks.
Okay, how does that work?
Well, new immigrants can enjoy a 20-year exemption on interest earned from foreign currency deposits, so dollars, euros, etc., held in Israeli banks. This means if you're bringing over substantial savings, keeping them in foreign currency in an Israeli bank can shield that interest income from Israeli tax for 2 decades.
20 years. Wow.
20 years.
Yeah.
It offers a vital shield for your nest egg as you transition. The main conditions are that the funds must have originated abroad before Aliyah. They need to be deposited within 90 days of transferring them to Israel, and you have to make a specific declaration to the bank.
Got it. And the second thing?
The second and very practical one is income tax credit points, or nekudat zikui. New immigrants receive these credit points against their Israeli income tax liability. They directly reduce the amount of tax you owe on income earned in Israel.
So this helps with your Israeli salary.
Precisely. It lowers your tax bill on your Israeli earnings. This benefit typically lasts for 4.5 years, that's 54 months, for those who made Aliyah from Chum 22 onwards. For earlier Olim, it was 3.5 years or 42 months. The value of these points can be quite significant, up to around 8,700 NIS per year based on 2025 values. That translates into a substantial tax break that directly impacts your monthly take-home pay.
So these are tangible benefits providing immediate relief and long-term stability, even on income earned within Israel. Good to know. Now, shifting gears a bit to future changes. I've heard rumblings about a significant update, sometimes informally called the Milchan Law, coming into effect in 2026. What exactly is happening there, and how will it impact new immigrants going forward?
Yes, this is a really important change that anyone planning Aliyah soon needs to be aware of. Currently, until January 1st, 2026, new immigrants benefit from that 10-year exemption, not just from paying tax on their foreign assets and income, but also from reporting them to the Israeli tax authority.
So no tax and no need to even tell them about it.
Correct. For those first 10 years, under the current rules, there's no obligation to declare those foreign holdings or income streams. However, from January 1st, 2026, this reporting exemption will be canceled.
Okay, wow. So the tax holiday on foreign income remains for 10 years, but the black box aspect, the not having to report it, that's gone. This sounds like a fundamental shift from don't tax, don't tell to don't tax, but definitely tell. Why is this change happening now, and what does it mean for anyone considering Aliyah in the near future?
Exactly. You've nailed the shift. This change is largely driven by international pressure, particularly from organizations like the OECD, the Organization for Economic Cooperation and Development, which sets global standards for financial transparency.
International compliance.
Right. Israel has faced pressure to increase transparency and combat potential money laundering, basically aligning itself with global financial reporting standards. So the 10-year tax exemption on foreign income will still be in place after 2026, but new immigrants will be required to report these incomes and assets to the Israeli tax authority.
So what's the takeaway for someone planning now?
The key takeaway is this. If you're planning Aliyah, it's highly recommended to consider doing so before January 1st, 2026, if possible. That way, you benefit from the existing reporting exemption for the duration of your 10-year period. That window offers a decade of both tax and reporting relief, which is, frankly, a significant strategic advantage that's about to disappear.
Okay, so we've covered exemptions, the adaptation year, property tax, other benefits, and this looming reporting change. What does all this really mean in practice? It sounds like an exciting landscape of benefits, absolutely, but also one that seems absolutely full of potential minefields if you don't navigate it correctly. It feels almost like too much for one person to track and manage independently.
You've hit on the core challenge there, and this brings us to the absolutely critical importance of professional guidance. There's this, I'd say, dangerous myth out there that every OLA can manage alone.
You hear that sometimes.
You do. But the reality is, the sheer complexity of Israeli tax law, combined with a system you're just not familiar with, can lead to incredibly expensive errors. For example, without expert advice, you might inadvertently find yourself in a situation of dual tax residency, where both Israel and your country of origin claim you as a tax resident.
Leading to double tax.
Potentially, yes, leading to double taxation or complex filing requirements. Or another common pitfall. If you own a foreign company and its management effectively moves to Israel with you, it could, under certain circumstances, be classified by the Israeli tax authority as an Israeli tax resident company,
Yeah.
meaning it could become liable for Israeli corporate tax on all its global income, not just Israeli-sourced income. These are just a couple of the minefields that only a specialized CPA, someone who deals with this daily, can identify and help you proactively avoid.
You called them a financial architect earlier. I like that analogy. So, in practical terms, what's the real cost of not having that architect? What's maybe the biggest or most common mistake you've seen someone make trying to DIY their Aliyah finances?
Oh, the cost of not having that expert guidance can be immense. Beyond the double taxation risk, I've seen Olim miss that crucial 90-day adaptation year deadline, losing potentially huge tax planning advantages. I've seen people forego significant purchase tax benefits because they simply didn't understand the old versus new regulations or the timing. Failing to properly sever tax residency in their country of origin is another big one, leading to years of headaches and unexpected tax bills down the road. But honestly,
Yeah.
the biggest mistake is often just a lack of proactive planning.
Waiting too long.
Exactly. Many people think, oh, I'll sort it out once I arrive. But by then, critical deadlines might have passed, or opportunities for strategic asset restructuring, like the step-up, might be lost or much harder to implement. A good professional will conduct a deep dive into your specific situation before you move. Your assets, income sources, how things are owned, even when you bought them. They build a truly personalized strategy. They'll ensure you properly and officially sever tax residency back home before Aliyah. And if you own a foreign company, they'll help you plan ahead to structure things correctly, preventing it from being inadvertently pulled into the Israeli tax net.
That's a powerful and, frankly, maybe a bit sobering perspective. So, for anyone listening who's contemplating Aliyah right now or perhaps has just arrived and is feeling overwhelmed, what are the absolute first three financial steps someone should take before they even land in Israel? Can you give us that crucial pre-Aliyah checklist?
Absolutely. My top 3 must-do pre-Aliyah financial steps are: first, sever your tax residency in your country of origin. And I mean, officially, get it documented, make sure it's properly communicated to the relevant tax authorities there. Don't leave any ambiguity. This is foundational to avoid future complications.
Okay, number 1, cut the cord back home, tax-wise.
Precisely. Second, organize your assets. Do a full review of all your foreign assets and investments. Understand their current tax implications, both where they are now and how they'll be treated in Israel. Consider if any step-up operations or restructuring make sense before you become an Israeli resident to maximize that 10-year exemption.
Number 2, get your financial house in order abroad.
Exactly. And third, and perhaps most importantly based on our discussion, seek early professional advice. Consult an Israeli CPA who specializes in international taxation and Aliyah as early as possible in your planning process. Don't wait until the last minute.
Don't see it as a cost, but an investment.
Absolutely. This consultation isn't just an expense. It's a critical investment in your financial future in Israel. It can save you a fortune, prevent massive headaches, and provide immense peace of mind during a complex transition.
This deep dive has truly illuminated the vast potential, but also the intricate details of the tax benefits for new immigrants in Israel. It's really clear that these benefits are an incredibly powerful tool, but they absolutely require a sharp mind, meticulous attention to detail, and definitely that proactive planning to fully leverage.
Precisely. And the good news is, with the right preparation and expert guidance, Olim can successfully navigate these financial complexities. They can truly maximize their opportunities and secure a strong financial future in Israel. But the landscape is dynamic. It is changing, especially with those upcoming reporting requirements kicking in from 2026. So timeliness and getting that expert advice are genuinely more crucial now than ever before.
So wrapping up, what does this all mean for you, the listener? If you're contemplating Aliyah, or maybe you've recently arrived, take a moment to consider how effectively you're leveraging these benefits. Are there aspects of your financial plan, maybe regarding your foreign assets, your real estate intentions, your business structure, perhaps even your health insurance choices during that first year that might need a second look in light of today's conversation? And perhaps the most provocative thought to leave you with is this. Are you truly in control of your financial future in Israel, or are you potentially leaving significant, maybe even life-changing savings on the table simply by not knowing all the rules and adapting your strategy before it's too late?